This is Nightly Business Report with Tyler Matheson and Sue Herrera.
August surprise, the Dow breaks through another big round number, 22,000 this time. History, though, says August is a tough month for stocks. Could this time be different?
Trade tensions. Washington looks ready to crack down on China. But could the move trigger a trade war between the world's two biggest economies?
And fair game. A new mobile game promises to take the U.S. by storm, but some are concerned privacy and safety aren't part of the ground rules. All that and more on Nightly Business Report for Wednesday, August 2nd.
Good evening, everyone, and welcome. Well, what's a day on Wall Street without a record? Pretty commonplace these days, and today was no different. The only thing that was different was that the Dow broke through to a new milestone, hitting and closing above 22,000 for the first time. As we mentioned last night, Apple's strong earnings would likely propel the index to a record today, and it did. So here are the closing numbers. The Dow rose 52 points to 22,016. Most of the gain was thanks to a 5% rise in Apple. The Nasdaq was essentially flat, and the S&P 500 tacked on a point. And with the Dow sitting above 22,000, it's worth keeping in mind that this is historically a bad month for stocks. But as Bob Pisani tells us, the hope is this time there's an August surprise.
Could we get an August surprise to help us beat a summer swoon? You know, August is typically a lousy month for stocks. It's the second to worst month of the year. It's only been up 5 times in the last 20 years. That's terrible. But the bulls are hopeful that they can confound all the expectations and pull out another monthly advance. The hope is that any profit-taking in technology after Apple's strong numbers will cause weaker sectors to rotate to the forefront. So rotation centers around 2 groups, energy and financials. Is this going to work? Maybe. For oil stocks to get moving, we need oil consistently over $50 a barrel. We haven't had that. But after being stuck in the 42 to 45 range for several months, oil is now trading in a regular $45 to $50 channel, and energy stocks have begun to respond. So names like Chevron and Schlumberger, they're all off their July lows, but it's still very tentative. The key to getting financials going is to get a modest breakout in short-term interest rates and get President Trump's administration to talk more about deregulation. That's the key. So expectations for a modest rise in rates have already begun to move large regional banks like BB&T and Fifth Third since earnings seasons ended a couple of weeks ago. But this, too, is really very tentative. Ownership of bank stocks are way up this year, and there's not a lot of confidence in the Trump agenda at the moment, and that's the biggest problem. Another hopeful sign, though, however, several subsectors that have been badly beaten up this year are starting to show some signs of life, and they may provide new leadership in August and September. So, for example, AT&T and Verizon, the telecoms, have been great since earnings. And the retailers, even retailers like Target and Gap, are finally starting to get over their Amazon funk. We'll see if we can pull out another rally for the third quarter. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Now to Washington, where it seems the Trump administration wants to get tougher on China over its trade practices. Multiple reports say the White House will open an investigation into China's intellectual property policies, which require American and foreign companies who want to break into the Chinese market to share their technologies with Beijing. It's believed the move is partly to force China to pressure North Korea over that country's nuclear program. The inquiry could result in tariffs or other penalties, but it could also prompt a trade war. Here to put it all into perspective is David Riedle, president and founder of Riddle Research Group. David, welcome. You understand how the Chinese think and how they react to actions taken from one side to the other. We've got lots of potential commercial disagreements with them, from how we deal with Chinese companies that want to invest in the United States to the dumping of steel or aluminum to the intellectual property matter. Do you think if we get tough with them on these commercial interests, that using that stick will cause them to be more helpful with North Korea or not?
I don't think so. They see the two issues as very, very separate, and they don't think they should be in the same sentence at all. Actually, someone in Beijing just said that this week. And remember, it's a very symbiotic relationship. They're our third largest export market, huge market for our agricultural products, especially soybeans. And of course, they're a huge source of imports into the United States. 98% of laptops in the United States that are imported come from China. 75% of cell phones, 93% of Christmas lights and Christmas decorations, 75% of cell phones. So it's a huge apple cart to think about upsetting.
You say that this actually could be a very good time with the People's Congress coming up for the U.S. basically to gain some concessions from Beijing, but you think North Korea is going to get in the way of that?
I think that's right. There's a great opportunity right now. The Chinese really want things to be calm and productive and positive going into this very important 19th National People's Congress in mid-October. This will cement President Xi's next 5-year term. It's really going to build his power. So he's really motivated to see things resolved smoothly and calmly here in the coming weeks. Unfortunately, I fear that Washington, D.C. is distracted by a lot of things, most notably North Korea.
We do, though, have some legitimate beefs with China, don't we, over their trade practices. They don't typically welcome our products with the degree of reciprocality that we would like.
That's exactly right, and it's been true for a long time, and it's something that many administrations have had to face. But they've faced it, I think, with a more even keel in terms of the way that they've approached this privately, diplomatically, maybe not so publicly. That is something that will rub Beijing the wrong way.
What do you think the odds are that we would actually end up in a trade war with China?
I hope they're very slim, because it would be disastrous for both sides, actually more disastrous for the United States. I think it would cause a lot of inflation here. It would cause a lot of dislocation of people's supply chains. And China has many other markets they can deal with in Europe and across Asia and other developing countries. So it would be messy all around, but it'd be especially ugly for the United States.
David, thank you very much for your help tonight. David Riedle with Riedle Research.
President Trump signed into law new sanctions against Russia, which Congress passed last week as a response to Russia's possible cyber attacks and interference with the presidential election. The new law allows Congress to stop any attempt by the president to ease the sanctions. Russia called the sanction the equivalent of a full-scale trade war. The president says he favors tougher measures, but calls this legislation flawed.
Well, it was a busy day for Mr. Trump. He now says he is supporting a bill by a pair of Republican senators that would cut the number of legal immigrants coming into the country by half over the next decade. The bill, called the RAISE Act, would prioritize high-skilled English-speaking immigrants. The president said the bill would be beneficial to the U.S. economy.
The RAISE Act will reduce poverty, increase wages, and save taxpayers billions and billions of dollars. It will do this by changing the way the United States issues green cards to nationals from other countries.
Joining us with more on these stories is John Harwood. John, the White House has said that the Russia sanctions bill for days, it's had it on his desk. The president said he would sign it. So what was new about his action today?
What was new today, Sue, was that the president put out an extraordinary signing statement with this legislation saying he thought it was seriously flawed, that there were clearly unconstitutional provisions in it, but he was signing it anyway for purposes of national unity. Now, in reality, the reason he signed it was there were overwhelming veto-proof margins in both the House and Senate. This was shoved down his throat, but he nevertheless gave a signal that he is not been moved on the issue of whether Russia should be sanctioned or not. He went along with it, but all along he's had a conciliatory stance toward Russia, and he said this would inhibit me from making deals.
Let's talk a little bit more about the story that Sue just mentioned. That is the shift back to immigration, Mr. Trump's signature issue. What does this RAISE Act purportedly do?
Well, interestingly, Tyler, even though most of the attention last year was on the president's fight against illegal immigration, he also favored reduction in legal immigration. And this bill would embody that policy. It's sponsored by Tom Cotton and David Perdue, two Southern senators. And they want to reduce the number of family members who can be brought in with green cards and generally cut immigration levels. This is something that's popular with the base, but not so popular with American business.
Yeah. Does it have any chance of becoming law?
Well, it does not have a good chance of becoming law at this moment, in part because of business opposition. You've heard senators today representing both agriculture and hospitality states say that by cutting legal immigration in this way, you're going to choke off the workforce we need as the economy is looking to grow in the future. One other aspect is one reason the American economy needs more labor is that we are aging. We've got more and more people going on to Medicare and Social Security. Without workers to pay the taxes to support those programs, everything is going to get more difficult.
All right, John, thank you. We'll leave it there. John Harwood in Washington.
On to housing, where there really hasn't been a summer slowdown, but even as would-be home buyers crowd into open houses, some are actually giving up. Diana Olick tells us why.
Demand for housing is still very high, but the number of available listings continues to drop, even now in summer when housing is supposed to slow down. Not the case. A demand index from Redfin showed the same number of buyers requesting home tours in July as in June, but the number of offers written dropped dramatically, down 11%. And that is showing up in the mortgage demand as well. Applications for a loan to purchase a home dropped last week and have been down 3 out of the past 4 weeks. This as mortgage interest rates hover near 5-week lows. It's not the rate, it's the lack of anything affordable to buy. And it's not just in the hottest markets either. The national supply of existing homes per capita is now at the lowest level since 1982, according to Capital Economics. That's because home builders dropped off the map during the recession and have still not returned to even normal historical levels of production. Even the number of vacant homes nationwide is at a 17-year low. Again, not demand, but supply. The worse this situation gets, the higher prices will go, which will sideline more first-time home buyers. For Nightly Business Report, I'm Diana Olick in Washington.
Coming up, Amazon goes on a hiring spree.
Amazon already has Prime Day. Now it has Jobs Day. The company is gearing up to hire 50,000 employees in just one day. So how was the turnout? We'll tell you coming up on Nightly Business Report.
We got a snapshot of the labor market today when payroll processor ADP said businesses added 178,000 jobs last month. That was modestly below what economists expected. The government's July jobs report, the official one, is out on Friday. The expectation there is for 180,000 new headcount.
And while Wall Street waits for that jobs report on Friday, Amazon is getting a jump on things. The company is holding its own Jobs Day around the country, hoping to fill tens of thousands of positions today alone. Deirdre Bosa is at one Amazon facility in Robbinsville, New Jersey.
This isn't your typical job fair. There are hundreds of candidates and thousands of open positions, but just one company is doing the hiring, Amazon.com. The e-commerce giant is hosting what it calls the nation's largest job fair at 12 locations across the country. 50,000 jobs are up for grabs, some of them filled right here on the spot.
This is a great opportunity, it's a great experience, and they're only hiring 1,500 employees, and I will be one of those 1,500 employees.
The line of candidates at Amazon's Robbinsville, New Jersey fulfillment center stretched around the building as candidates waited for their turn to apply, tour the warehouse, interview, undergo a criminal check and drug test, and hopefully get an offer. Amazon's hiring frenzy underscores the company's growth and consumers' shift to online shopping at a time when traditional retailers are closing stores and cutting jobs. These applicants have been waiting here in 90-degree heat for hours, all for the chance to apply for one of Amazon's warehouse jobs. But as Amazon automates more and more of its tasks, the question is, will these jobs be here a few years from now? We asked John Olson, VP of Human Resources for Amazon's worldwide operations, about the role of robots in Amazon's warehouses.
We've had automation in our sites for years, and we continue to have large numbers of employees in those sites as well. And so we'll continue to hire. Our 50,000 hiring goal for right now is testament to that.
While robots may work in tandem with Amazon's human employees for now, Amazon is developing its own technology to expand automation. At its Amazon Go grocery store in Seattle, its technology has eliminated the cashier. But for now, Amazon is quickly becoming one of the top employers in the United States, breaking the top 10 last year. For Nightly Business Report, I'm Deirdre Boza in Robbinsville, New Jersey.
The CEO of Mondelez steps down, and that's where we begin tonight's market focus. Following the snack company's better-than-expected quarterly earnings and revenue, the maker of Oreo cookies said its chief executive, Irene Rosenfeld, would retire later this year. Rosenfeld will be replaced by the CEO of Canada-based frozen foods company McCain Foods. Shares of Mondelez rose 1%, and all the Oreos she can eat to 44.10. Qatar Airways said it's no longer seeking a stake in American Airlines. The Middle East carrier recently expressed interest in acquiring a stake in American. As much as 10%, that would be a move that American CEO called puzzling. But now Qatar says the investment no longer meets its objectives. Shares of American were off 1% at 50.45. And Hasbro has reportedly ended talks with the movie and entertainment company Lionsgate regarding a potential merger. Reuters said the toy maker stopped negotiations after the two parties couldn't agree on a price. Shares down 1% to 104.77.
Strong demand for new products helped Fitbit grow sales and beat analyst estimates. The wearable device maker also reported a narrower than expected loss. Fitbit shares initially popped in after-hours trading, but finished the regular trading day, down just a tick to $5.07. Some of the largest insurers also reported after the bell, and the results were mixed. MetLife saw earnings rise, while Prudential's profit was nearly cut in half. AIG also reported lower income, but those results still topped expectations. MetLife shares ended the day down fractionally, while shares of AIG and Prudential were higher. And after the bell, Tesla reported a loss, but it was better than what Wall Street was looking for. Sales at the automaker climbed higher and topped estimates. The company said production on the new Model 3 is on track to meet targets, and Tesla expects deliveries for the Model S and X to increase in the second half of this year. Tesla shares initially were higher in extended hours session, and they also ended the regular day up nearly 2% to $325.89.
And the transportation system, first conceived by Elon Musk, hit a new benchmark, its fastest speed yet. In the Nevada desert, the so-called Hyperloop passenger pod hit a top speed of nearly 200 miles an hour in about 5 seconds. The plan is eventually to get it up to a top speed of 750 miles per hour. The company Hyperloop One hopes to have its first functional system by 2021.
If you are one of the millions who bought a used car or truck this year, you're part of a huge shift in America. Used car sales are surging to record levels, while interest in new models has cooled a bit. And as Phil LeBeau tells us, that has industry veterans steering in a new direction.
Whether you call them used or pre-owned, nearly new vehicles are once again the hot models in showrooms. This year, Americans are on pace to buy more than 41 million of them. An all-time high. Now AutoNation, the country's largest new car dealer, is opening its first used-only store.
When I look at AutoNation, 3-4 years from now, our pre-owned business will be larger than our new vehicle business. Now, don't get me wrong. We're going to run the manufacturer play. Right. We're going to give away as many new cars as we can. But as far as where we're going to grow our profits, that's going to be in pre-owned and customer care.
Why are sales of new cars and trucks cooling off? In part because so many people have bought so many new vehicles in recent years, there's simply less demand. At the same time, there's a glut of used vehicles rolling into dealerships.
Because of all the lease programs started 3, 4, 5 years ago, we now have 3.5, 4 million, 4.5 million vehicles that are nearly new coming back to marketplace. And consumers are looking at this and say, well, that's a great value.
For auto dealers, the used market has always been lucrative because older cars require more work. But these days, there's another reason owners are bringing their cars in for servicing. They're more complex, loaded with sensors and numerous high-tech features. So doing a repair at home is not as easy, which is why AutoNation's used dealerships will not only feature more service bays, but also a collision center and a wholesale auction lane where other dealers can buy and sell used cars. AutoNation is not the only dealer that will be opening stores that sell only used models. Group 1 is doing the same thing, and of course CarMax continues to expand its footprint around the country. Proof that pre-owned or used vehicles are more popular than ever. Phil LeBeau, Nightly Business Report, Chicago.
Last week, we told you that Wells Fargo apologized for issuing auto insurance to more than 500,000 people who didn't need it. Now, New York State's banking and insurance regulator has issued subpoenas to a pair of Wells Fargo units over this issue. This is the bank's second scandal in the past year. The first dealt with more than 2 million bank and credit card accounts that were opened without customer permission.
Up next, why some think a new mobile game craze coming to the U.S. should also come with a warning label.
Playing games on your smartphone is big money. How big? Well, the industry is expected to rake in over $100 billion this year. And now there's a new hot game coming to the U.S. that could be even bigger than last year's Pokemon Go craze. But is the price your privacy? Andrea Day reports.
We've got big things planned.
Not long before their new game drops in the U.S., and founders are hoping that Snatch is the next Pokemon Go.
The response in the UK is amazing.
The gaming market expected to top $130 billion by 2021.
We're using the latest technology in augmented reality and geolocation.
They call it a virtual treasure hunt. But instead of searching for digital monsters like Pokemon, players hunt for real prizes and cash. The trick is holding onto your prize for 6 hours, while other players have the chance to snatch it away.
We're hoping that when we launch in the US, the first prize on the top of the list will be a car.
Snatch says its partners include major brands in the States, but won't release any details yet.
It's not just about giving away free things, it's about bringing Snatch and that brand together and developing that relationship, which then in turn delivers the actual brand messaging for each of our individual brands.
But privacy experts warn against blindly downloading any app. Attorney Alex Urbelis.
In exchange for some entertainment, we are giving them our data.
Data, he says, that could include your contacts, photos, location history, email, and more.
These social networks and these social applications are collecting an enormous and exponentially larger amount of data than any active intelligence agency in the world would arguably collect on people.
And he says most have no idea how that data is being used or secured.
I'd be more interested in learning from Snatch what they will not do with my data, rather than what they plan on possibly doing.
According to Snatch, a new privacy policy is in the works for the U.S. launch, and data is only collected to make the gaming experience better.
We don't give any of our data out to any of the brands that we work with.
Beyond privacy, former LAPD chief Michael Downing says that gaming apps like this are a concern for law enforcement.
If they're put in the hands of the adversary, they could use them to identify where large groups would gather. I think parents ought to be oriented to what the possibilities and potentials are of luring kids to certain locations.
And he says the big thing to tell kids is to watch your surroundings and don't keep your head buried in the phone. You can download the Snatch app right now, but you can't really play or win prizes until they officially launch later this year. For a Nightly Business Report, I'm Andrea Day.
Well, take a look at shares of AMC losing more than a quarter of their value after that company said last night it expects a big quarterly loss, citing declining industry box office trends. Some of those trends could be the emergence of new options for moviegoers. Julia Borston takes a look at AMC's pain and what is hitting the industry.
A weak summer box office and the rise of at-home entertainment options like Netflix are taking their toll on the nation's largest theater chain. AMC warning isn't just confined to this quarter, saying the future doesn't look like it will be much better. The company forecasting a, quote, very challenging third quarter.
You have a very tough August comparison coming, so I think they're trying to get ahead of the curve. It looks like backing into the numbers, we get to like a minus 15% for the box office in the third quarter, and that'll probably have an impact on Cinemark and Riedle as well.
The company also unveiling a cost reduction plan, including strategic pricing, promotional incentives, and reductions in operating hours. AMC blames a lackluster U.S. box office, dragging its U.S. ticket revenues down almost 4.5% in the quarter. The company also taking a $203 million charge on its investment in in-theater marketing company, National Cinemedia.
Here you are, enjoy.
AMC's pain echoes industry-wide box office declines, down 8% so far this summer, the result of a number of critical failures, as well as the rise of at-home alternatives, such as Netflix. Its shares are up more than 90% in the past year as the company continues to add more subscribers than expected. But MKM's handler says moviegoing will hold up over the long term.
There's been expanded entertainment options for 20 years. And the industry is held in quite nicely, and we continue to reach new highs. So I still like the industry. I still feel good about the prospects for growth over the next year and a half.
We'll hear more about AMC's plan to battle the rise of streaming when it releases its official second quarter earnings and holds its conference call on Monday. For Nightly Business Report, I'm Julia Borston in Los Angeles.
We both have sort of teen and preteen children. And if it weren't for taking them to a movie they want to see,
exactly,
I wouldn't. There's not much I want to go see in a theater.
There's not much you want to see. I know that's really true.
I'd sooner stay home and watch something off of
Netflix
on demand
or
Netflix.
On demand. Yeah, I think that's very true. And even my kids are not finding as much at the box office as they have previously.
And so much of the movies these days are the extensions of existing franchises.
They're sequels.
Anyhow.
What are you going to do? That's Nightly Business Report. Thanks for joining us. I'm Sue Herrera.
And I would be Tyler Mathisen. Thanks for watching, and we will see you back here tomorrow night.